Hi, everybody. Welcome to Get Think Tanked. We're excited you're joining us today. We have a phenomenal show today. We're going to be talking about banking and all those head-scratching news we keep seeing in narratives about the disconnect between markets and banks. We have a great guest today. Chris Whalen is joining us. I'm Cynthia Murphy, head of research for the ETF Think Tank, which is part of Title Financial Group. We'll do a quick round of introductions, and then we will get to Chris. Weisskopf, would you go next?
Sure. Dan Weisskopf here, otherwise known as the ETF professor and also co-portfolio manager of Block and lead ETF strategist for the ETF Think Tank. So David, you're up next, my friend.
How's it going, everyone? David Chikansky here, fellow portfolio manager within the Title Financial Group. Very excited and very timely to have Richard on here and kind of help us navigate what's going on in the banking world. So Richard, if you wouldn't mind, introduce yourself. Give us a little bit of a background of who you are, your advisory firm, and any initial thoughts on the market to help us solve all of the problems of the banking industry. So,
yeah, my pleasure. Thank you for having me. I'm Richard Christopher Whalen. I go by Chris. So my poor father doesn't get blamed for my writings. He's an author too, biographer of Joe Kennedy, among other things. But yeah, my firm, Whalen Global Advisors, is a consulting firm focused on doing two things, really. I spend a lot of my time in the mortgage market, working with some of the bigger Ginnie Mae issuers. And then I also publish the Institutional Risk Analyst blog, and we do a fair deep dive on banks. We publish a quarterly on the banking industry, and I am getting ready to publish a bank index, which will only be the good banks. Imagine that.
Only the good banks, he said, right?
Well, I did some research. I've spoken to you guys and a number of others about ETFs over the past year, and none of the passive strategies differentiate between the good performers and the bad. Also, the sell-side firms that publish indices don't exclude anyone. They don't say these are the good ones, these are the underperformers. So I think we're just going to draw a line at the page, much like I did when I built our early bank model 20 years ago. And we said, okay, where's the center line? If you're above the average, which was 1995 in those days, you're good. And if you're below the average, you're not good. And you stratify the population in that way. It's a census, basically, based on equity returns and efficiency. It's pretty easy to do. And obviously, you have to have total market returns, too, as one of your axes. So those three, that's enough.
So, quick clarification. So sorry, David, but like when you say the good banks, good for who? Good for the depositors, good for the investors, good for the market? Is it just
consistent equity returns, strong operating leverage, and obviously good market performance? If they don't get recognized for doing well from an operating perspective, that's a problem. So you have to score all three. But I think equity returns captures most of what you need to know. Operating efficiency is about management. How good are they? You can go deeper into it, but I think if you pick one factor, that's what you use as your surrogate for kind of the M and the camel rating, if you will.
So we have efficiency of use of capital. We have like market recognition. We have like governance. What is essentially? So what are you looking for in governance out of the bank?
If they can maintain at least peer operating efficiency. If they're above peer, and I use peer group 1 to draw these banks, it's 140 some odd. About 15 of them are not public. They're kind of funny, interesting institutions like Apple Financial, by the way. We'll flag that one for you. There are some corporate-owned banks in that top group, but anything from 10 billion up to JP Morgan is really the prime spot for investors because of liquidity. You can find some great banks from 10 down to 1, but, they're really private equity, essentially. They're too small.
I'll keep going unless Weisskopf or Cynthia have questions, but so how many banks are too big to fail versus the last time around, and do you overweight the too big to fail banks? Like, are those like your Magnificent Seven in the banking industry, and you just build around that? Like, how does that work?
Because those are underperformers. The big guys, other than JP Morgan and US Bank, tend to underperform the group. Wells most recently, but they're coming back. I actually just bought some Wells I think slowly they're going to rebuild in terms of their operating performance. But really, the street buys size. They want liquidity. So if you are looking for value, what you do is you go below the top 5 and you look at that next 25 because they can do things. U.S. Bank just got done with a very large acquisition in California, Union Bank in California. So they're probably the only bank in the top 5 that's allowed to buy something right now, if you think about it. PNC could do an acquisition. Truist could do an acquisition now that they're done with SunTrust. I hate that name, by the way. I wish they'd go back to BBT. What are you going to do? A consultant made a lot of money on that. I want to meet this person.
So, Chris, I mean, there's been a lot of talk that there are just simply too many banks, particularly regional banks out there. Are you in that camp that there are just too many?
No, people who say that don't understand banking. Small banks, small mortgage companies, small credit unions do much better jobs of creating credit and managing credit. The big guys tend to be buyers of loans. Okay, they don't make loans. They buy loans from other firms. Even JP Morgan, they're still one of the biggest correspondents in the country. So when you look at it that way, you say to yourself, okay, who knows the customer? Who can call that customer and work with them if they have problems? Because under today's rules, today's legal environment, you have to help them. You have to have a whole waterfall of loss mitigation strategies when you're dealing with the public. So who's equipped to do that? Little credit union or a little bank that knows you. So I think we don't want to have fewer banks. We want to have banks that are perhaps a little simpler. And we also need to renovate the system for funding them and managing them from a regulatory perspective. It's, it's like the 1930s. It's like nothing ever changed. But things have changed. When I sent a letter to comment on the new Basel proposal, and they're still worried about capital and credit risk. And yeah, we're going to have that. We're going to have a lot of credit risk on the commercial real estate side. But it's going to look more like the 1970s in Texas than it's going to look like 2008. That's what people have to get their head around. This notion that it's all small banks, and that's where all the problems are, is nonsense. Take a look at Bank of America, all right? Brian is underwater by over a point. Thank you so much. And he keeps putting more securities into held to maturity. That's not good. The guys who are strong, who are taking losses on legacy securities, are the ones you want to follow because they're going to increase their yield and they're going to work their way out of the hole. And I'll just give you a final thought. Isn't it interesting that the Fed is sitting here talking about banks failing, and Janet Yellen too, by the way. And at the same time, you have the insurance commissioners quietly helping their members sell low coupon securities. They're going to let them count the loss as capital until the end of 2025. Tails of the S&L crisis, right? But it's the right thing to do because those insurers are going to end up stronger. They're going to be in much better shape.
So as you said, it's the small banks that are both originating and more likely to house on their balance sheet these commercial loans, right?
All commercial, yes.
Yeah, I've been talking for...
Yeah, that's right. Little banks don't do much. They do basic services for consumers. They do commercial lending, maybe commercial real estate lending, small. Maybe they have access to the Federal Home Loan Bank if they're above $1 billion. But they have a very limited product set. So when the commercial real estate market goes into the tank, as it is, obviously they're going to get hit, no question. But I think those small banks will actually manage the credit losses better than the large guys. The large guys are not good at servicing. They're not good at loss mitigation.
I have a chart in front of me that says about 7% of the large banks' balance sheets are commercial real estate, whereas about 30% of the small banks' balance sheets are in commercial real estate.
Yeah, that's about right.
Based on what we saw this week, right, it's a very few are probably at the average, right? So why don't we take this as an opportunity to, if you could, view to the world, like what happened with New York Community Bank? Where are we this week with this crazy bank and all this action we've seen out of it, and how insulated the rest of the banks seem to be from it, right? That's what I was most intrigued by, is that, like, well, what was it? It was it and another bank in Japan that had lots of commercial real estate holding did pretty poorly. Like everything else, that there's no fears of a return to last year. So where are we in this? And why isn't there fear of like contagion across the small banks?
Last year was about liquidity and about surprise. Systemic events are about being surprised, right? By definition. Jerry Corrigan said that. So when you look at today, it's still a surprise. We've been writing about commercial real estate for the last 18 months. If you read Trapp or, The Real Deal, New York, great publication, by the way, and just look at the headlines, you get a sense for what's going on. So in the background, we've already been restructuring a lot of commercial real estate, and the losses in some cases have been very severe, well more than the equity in the deal. You typically have 50% equity in most commercial real estate transactions, the mortgage. So you wipe out the owner, quote unquote, and the bank owns the property. What do? Well, you try and sell it if you can, or you sit on it and you work it. And some of the banks are going to do that latter. They're going to work these properties and wait because they can. Banks have an enormous capacity to slow walk these loss events, especially if there's a bankruptcy involved. They won't tell you for years. So what I'm saying to you is that, yes, this is a problem. It's a problem for small banks because it's a concentrated risk as opposed to JP Morgan, which is only half bank. Bank of America is only half bank. The other half is the broker-dealer and various investment activities. So from that perspective, yes, their commercial book is smaller as a percent of total assets, but it's very big. Don't fool yourself. There's a lot of mezz finance in there. There's all kinds of things in there. And I think that it's wrong for the narrative of Wall Street to say, oh, well, this is a small bank problem. It's not. We've got a mark-to-market problem that got better last year, thank God, because we had the rate rally. That helped earnings, by the way, dramatically. Most people don't realize that, but between that and the arbitrage on the term bank funding program, which we're going to end, that was a lot of earnings. Bill Moreland was writing about that in a note he sent me today. So I think that, we have to realize that this commercial real estate problem is going to be with us for a while. It's going to be idiosyncratic. We're going to get lumpy disclosure from banks. One quarter, they're going to flush. One quarter, they're going to get a big recovery. Well, and that's the nature of commercial. But of the $2.5 trillion worth of C&I loans on the books of U.S. banks, about a third of it's real estate. So, there's some big credits in there. And, this isn't just the legacy cities either. You can see the same problem in Dallas or Cincinnati. Any of the big downtown areas, you have real estate that's got to be repurposed. So next week, actually, I'm going to do a little history lesson for everybody about the Reconstruction Finance Corporation and why we need to resurrect this right now, just to help cities deal with insolvency. Because let's be fair, what happened during COVID to help landlords? Nothing. So we had loan forbearance for 2 years. We had quantitative easing, which pushed credit indicators down to zero, but nobody thought about helping the owners of these big assets. And many of them are spent. They just don't have any capital to put into a refinance transaction if the value of the building is fallen 30%, right? They have to top off 50% equity if they want the bank to roll the mortgage. That's basically, if you want to just put it in a capsule, that's the problem facing everybody. We've gone from a commercial market that only went up to a commercial market now where the assumption is loss. And that's what's getting the regulators all up in arms.
Wait. You said the problem that we had before was a function of surprise.
Yes.
And I know you're right on that, but people who were surprised about getting the duration risk wrong.
Yeah.
I mean, hello,
I know.
It's kind of shameful that people would have been surprised by that.
I know.
Bankers.
Well, only mortgage geeks were watching that Ginnie Mae index on Bloomberg. And in 19, when I saw them pushing it down, I'm like, what's going on? What's happening? And it was because Powell had mandated much bigger reserve positions. They didn't want to have another problem like December 18, right? So by the end of the year, the whole complex of Ginnie Mae securities is down to a duration of about 1.5. It had started at 5. And I would have told you that was impossible. But then we took it down lower. And this is the same time Silicon Valley Bank is buying mortgage-backed securities. So it's like, and by the way, again, look at Brian Moynihan at Bank of America. he could have sold all those 2% mortgages he made during that period for 104 and bought T-bills, but they kept them. I have friends that have twos from Bank of America, wealth management clients, right? Well, a two is still trading in the 70s right now. No, the average return on his investment book is 2.5. So don't think this is a small bank problem, because we still have the mark-to-market problem. It's just not as bad, much better now. But now we have to raise liquidity to go out and remediate bad commercial assets and sell them. And, when you end up owning a building as a bank, do you think the city of New York is going to let you abandon the building? All the municipalities will make that bank lender keep that building forever. And they'll be spending money on it. So our last piece, we said loss given default could be more than 100%. A lot of people ask me about that one. So,
can you describe a little further the history of the Reconstruction Finance Corporation, the RFC, and because basically from just the Great Financial Crisis, right? Like basically the conundrum there was like no bank wanted to take a dollar unless all banks were taking dollars, right?
Yeah.
So how does this differ from that? How was it in the 30s, and how do you foresee it happening now?
Well, in the 30s or the late 20s, banks were private. You had the Federal Reserve System, but you didn't have the FDIC yet. So the Fed was very leery about lending to banks, because if the bank went bust, they would end up in a state receivership. No FDIC as receiver. You would end up in whatever state that bank was based in, and the Fed would have been a general creditor. They would have had no special status in front of that court, right? So it was only until they started realizing, this was Herbert Hoover, that they had a deflation problem. And it wasn't in the markets yet. This was out in agriculture and other parts of the economy, that they created the Reconstruction Finance Corporation about 2 years into his last term. They didn't know what to do with it yet, but they created it because they thought they would need a parastatal entity, a big GSC essentially, that could come in and restructure busted banks and companies. A guy named Jesse Jones, who was from Houston, came to Washington during this period looking for help. And they said, why don't you stay? So they made him chairman of the RFC. And again, they didn't quite know what to do with it, because in those days, communications were very, very slow, extremely slow, carrier pigeon. So by the time FDR gets into office and Jones is talking to FDR before he takes office, they knew they had a problem. So the RFC restructured everything in terms of banks that couldn't qualify for federal deposit insurance in 1933. They had the bank holiday, and then you had to come forward to qualify for federal deposit insurance. And Leo Crowley was running the FDIC. He created the agency and set it up the way it is today. He was the money man behind FDR. And Leo Crowley later ran Lend-Lease during World War II, a giant financial genius. So him and Jesse Jones restructured the U.S. economy. It couldn't qualify for FDIC insurance. You would go see Jesse, and Jesse would look you in the eye and say, go home and raise money, or I'm going to put you in jail. Yeah, that's how they dealt with bank crises in those days. And, he wrote a book called $50 billion, my 13 years at the RFC. And they not only fixed the economy, but they funded World War II. So it's a very good story.
So coming back to David's question, though, on New York Commercial Bank Corp, two questions. One, did the government get out of their stock from the previous? And NYCB, didn't the government take a stake in the bank?
What, as a result of the FDIC transaction? I don't think so. I would have to go back and check. I don't think they had any preferred, no.
They did. They had some transaction in order to facilitate
something else.
It was something else.
It could have been, because, that was a messy transaction. But let me answer your question. New York Community Bank was a sleepy community bank. In 2022, they began the acquisition, or even before that, of Flagstar, which is a Detroit-based bank, but it has a national mortgage business. It's a very large servicer in the Ginnie Mae market, $300 billion in unpaid principal balance of loans. And it's also a platform that some services for many, many other institutions. So I own the stock. I actually bought some on the way down. My attitude is, even if the current management team, which has just changed and now has the former chairman of Flagstar running the whole thing, they'll get bought because it's too significant of an institution to let it dangle. If they were to get in trouble, I think a larger bank would take them out.
Chris, can I ask you to go back, as we were talking about, the commercial real estate? You did such a great job detailing all of the challenges. So
I don't know if we've done that.
What's the opportunity for, the trouble is huge, the challenge is huge. Is there an opportunity here in this space that we're looking?
The opportunity, I think, really, Cynthia, it's that we have to figure out a way to restructure an awful lot of commercial real estate in big cities. The industry will be happy to participate in that, but they can't do the lift. The numbers are too big. And that's why I'm thinking that we may need to have some sort of government-funded vehicle to come in partnership with private developers and start buying up some of these buildings and literally knocking them down, putting something else there. Look at New York City. Look at all the B and C real estate in Manhattan that has to compete with new construction now with a much, much lower level of utilization throughout the city. Look at 3rd Avenue between 34th Street and 59th Street in Manhattan. Look at downtown Chicago, downtown LA. It's the same problem. So I think, because we've had a change in behavior in the way people use office space and the amount of time, I go into the city twice a week now. That is not enough to run the city. And you can't just make all of New York residential because that's not going to pay for it either. You have to have a commercial base. But unfortunately, in New York, the politics, the progressives are crazy. They have literally destroyed multifamily real estate as an asset class in this state. So that's why Signature, I told my friends at FDIC at the time, I said, don't close this bank. This is an idiosyncratic, funny bank that deals with a very peculiar constituency in New York City, and nobody else wants them. Now, New York Community serves some of the same people too. It's a very, very old relationship that they've had with these developers and managers of multifamily real estate, and people love that asset class. And small business people invest in those assets because they're always fully let. That's the irony. It's that these assets will keep cash flowing for the lenders, but the problem is the owner can't sell the building.
Can you further define what you mean by restructure and also like who the operator is? Because as you mentioned, a lot of these guys are being asked to say, hey, you want to sell this asset after this mortgage? Like you have to actually double up every dollar you ever put into this building, right? Like right now, so for that funds, you put down 20%. Now you need to put down another 20% just to keep your ownership, even though your cash flows aren't that strong. Do you want your building, right? So
at a higher cap rate.
So who are they Who are they restructuring? The current owner or the banks, right? The banks can't operate these vehicles. No. And so if it's a federal grant, right, you still need local municipality tax grants or something to actually allow something to occur. So is this who's operating these things? So it's just a whole new group.
No, you'd have to have a very, very complex partnership between the cities, the private developers who have the competency to manage these assets. You're absolutely right. And then the government, I think, would provide financing, ideally. But the numbers are too big. We have $30 trillion worth of commercial real estate in the United States. And notice that that number has gone past the total value of residential real estate. That was not the case 20 years ago. 20 years ago, commercial was tiny. And what's happened is a lot of the buy-side community, the endowments, private equity funds have bid up the value of a lot of commercial real estate in an aspirational way. And now it's going to come back down. That's kind of a parochial concern. The bigger concern is just we've gone from a deflating or an inflating market to a deflating market. That to me is a striking thing. And then everybody ran out of blue states where they didn't like the politics, and they went down to Texas and built more. In Florida, go look at Dallas or South Lake or any of these areas. They are so overbuilt, it's mind-boggling. But they'll deal with it.
So I'm gonna go to Eric Connolly's questions. He's always great with all his questions. So be prepared here, Chris. Okay.
Oh.
And his questions are listed under the Q&A. His first question is, what are your thoughts around CLOs and BDCs making higher coupon business loans?
Well, I see the funds and the BDCs getting into more and more business lending. It's a dangerous game if you don't have bank funding. The banks have a natural advantage there because of their cost of funds. So, I get it. I have some, companies I watch that actually lent on residential mortgages and MSRs. And these are broker dealers. Okay. They have no funding advantage at all. Same with Goldman. Goldman finances that business. Do they have a funding advantage? Not at all. So I think, a lot of smart people are going to jump in here because they think they can manage the credit, but their weaknesses are funding. They don't have the extra money. If I'm a U.S. bank, can I mothball commercial assets that I can't sell immediately? Yeah, because I have the funding. So. Oh, I think our boy froze.
We're just blown away and terrified at the same time.
Well, I give you an example. Schwab, everybody thought Schwab was going to fail. Schwab still has the lowest cost of funds in the top 25 banks. And they're going to shrink that bank. The bank's going to disappear. It was a problem. It was a trade. Think about that. At one point during COVID, 21, I think it was, Schwab was bigger than U.S. Bancorp. Think about that. That is not a natural state of affairs. But they got the idea. They're shrinking it fast. The advisory business is the whole point anyway.
We have another question from our friend Eric in the chat that I'll get off here. So who was Yellen referencing when she noted regulators were keeping a close eye on non-bank mortgage lenders in her Senate testimony today?
She's probably referring to the FHFA, the regulator for Fannie and Freddie. The Treasury people watch too. Why? A reverse mortgage lender called Reverse Mortgage Investment Trust failed in 21. The Treasury owns that book now. One of the largest HECM lenders in the United States, grandma and grandpa, late night TV. They are probably going to end up owning 2 more of those portfolios when they fail because no one's going to want to buy them. The problem with non-banks is this. The non-banks themselves perform very well. Look at Cooper and PennyMac. They outperform the banks by a long shot. The trouble is that when delinquencies go up, a Ginnie Mae servicing asset can literally have negative value because of funding. And that's why if you look at some of the bigger issuers, the private ones, they're very conservative and they don't hedge. They don't spend a dime on hedging because they know they don't need to. They're private. So the guys at Bayview, Freedom, all of them have much higher total returns than the public companies because the public companies have to hedge to kind of manage their appearances, even though they don't really need to from an economic perspective. So it's funny, when I hear Yellen going on and on about this, a lot of what she is saying comes from the guys over at Ginnie Mae, and they've been wringing their hands about non-banks forever. But the truth of the matter is the non-banks are 2 or 3 times more efficient than the commercial banks. They fund off the commercial banks. But is Jamie Dimon going to cut off any of his customers and lose the escrow balances? No. That's what they don't understand. The non-banks bring deposits to the banks. So is the bank going to tell the non-bank to leave? No. They make money. They're lending the non-bank his own money. But there's such a lack of expertise and subject matter competence in Washington today when it comes to finance. It's mind-boggling. It really is. The Basel proposal is a case in point. So I will tell you this. So you asked a very important question, David. Why are they talking? Why is Janet Yellen and Jay Powell both talking about bank failure and non-bank risk all of a sudden? Normally they wouldn't say a word about that in public. So think about that.
But it goes back to, and we've talked about this for the last year, the whole question of credibility, right? We've questioned so many times, are they even credible anymore? I mean, do you really believe that they completely lack the expertise, or they're playing some other game, and we're just trying to parse it. What's the ultimate goal?
I deal very much with the agencies in Washington that regulate financial institutions, and they're quite light. We've had an awful lot of retirements over the past 5 years in agencies like the Fed and the FDIC. So there's been a huge drain of institutional experience and knowledge from these agencies. And I do worry about that. But, back to that question about CLOs, what are regulators worried about? They're worried about CLOs. Look at the Basel III proposal and what it does to securitizations, okay? Factor PE, I think it's called. That evidence is what they're really worried about. They're worried about funds. They're worried about CLOs and things of this nature. They're worried about banks buying CLO, okay? So, stay tuned on that one. I think that's one of the areas of Basel that's not going to change. I think they'll back off on the mortgage stuff, by the way. They're going to have to. Otherwise, we'll have realtors tracking down Jay Powell on the way home.
Chris, got a question regarding technology. I understand that a lot of the banks, including JP Morgan for that matter, are embracing tokenization, blockchain. Forget crypto for a second, because I don't want to even go there on that. That's not really relevant to my question. What other banks besides JP Morgan are embracing tokenization in your mind? And do you really see that as a positive trend in banking?
Well, Bank of America spent an awful lot of money on blockchain early on. There were a couple of others. I've never had anybody show me operationally that using this methodology is much more efficient than an XML table, which is what we're really talking about here. I've been following, W3Gs for a long time, and, I'm old enough to remember when there weren't computers. So I've always been taught by my friends on the West Coast that simple, faster is really the way to go when it comes to any kind of financial transactions. You want them to go quick. That's what Bitcoin never made sense.
But does it go any quicker than blockchain, right? I think so. As a bank structure, right? Like we went from a society from like single ledger accounting where there was one person in town who had the ledger, and if you had an eraser, your assets disappeared, right? To dual ledger, which is the world we exist in now, versus blockchain is, I forget what they call it. They have a triple ledger, but it's everyone has all transactions.
Yeah, it's ubiquitous.
Right. So you don't see a value in actually speeding up transactions because of that. I think this is actually something our co-founder and CIO Mike Nudo often says is like, the only thing they can't solve is like bringing the money back, right? T+0 settlements. Like you can't unwind T+0, but like
that's right.
It's valuable to have T+0. So I do think there's got to be some efficiency in guaranteeing a borrower's cash flows, right? Without actually having to look into it and things of that sort. It's like, it's all public ledger. You might actually be able to originate quicker too.
Yeah. If you can be sure of the validation, number one, and your point about getting the money back is the issue. In any payment system, you actually build efficiency in. You build no. So today, if you're a mortgage lender, you actually have put no's in place to slow down the transaction. You want people to come up against a hard stop and then have to go and validate the decision to originate a wire transfer. They may even have to call the customer again. And that's because of fraud. So you have, on the one hand, criminality and other, bad things that are trying to interrupt the process. And then you want speed. So we have Fed now, where we're going to try it, get to instantaneous or at least intraday transfers for significant transactions. It's in battle. I think everything we do now requires double authentication. So it's just a question of, we can make the transactions go faster. Of course we can. I'll give you an example. When the SEC adopted XBRL, we were part of that effort. We were brought to the Kool-Aid party by Pricewaterhouse. And they kept saying to me, gee, Chris, aren't you going to, open these files on the internet and do financial analysis? I said, no, I'm going to drain all the numbers out of that file and put them in a flat file because they're going to go faster. So in that sense, nothing has changed. The back end is still COBOL, guys. We just call the front end different names now. but that's the reality. When I work with the FDIC data, it's so damn big, you can't even put it on a PC. And it's still in COBOL, by the way.
I love the behind the curtain look. Like, this is what really happens when we...
Well, why does the Bloomberg terminal go fast? It's because they pre-calculate all the answers at night. People in the background at Bloomberg gather data, and they pre-calculate every possible answer to any query you could ask, so that by the time the coffee cup gets to your lip, you have an answer. That's what the customer wants. And they will tolerate inaccuracy in the name of speed. Now, if you were going to lose millions of dollars because of the inaccuracy, then you have another issue operationally, right? And you would lock it down. So it's a tug of war. The fraud stuff that I have to deal with, on the FINRA side is amazing. It's amazing. And then, of course, I have my public website. I have a whole catalog of stuff that I get. It's amazing.
So there's a company, Figure Technologies, that has enabled banks to do HELOCs in 5 minutes.
Mm-hmm. Okay.
Is that surprising that it's only 5 minutes to you? Or I think we're talking about $10 billion, which in the grand scheme of HELOCs isn't huge, but they're doing it on the blockchain. And in 5 minutes, I'd rather do 5-minute HELOC than 5 days, 10 days.
Let's see how they look a few years from now. That's what I'll say. All of the AI driven stuff that I have been shown is not really AI. It's far more simple than that. Look at Upstart, look at, Affirm, all of these guys that are using algorithms for lending decisions. We'll see. Once we go through a credit cycle and you see Capital One back up at 8 or 9% gross charge-offs, then we'll see how the fintech guys are doing. And frankly, I'll just say, going back to that earlier question about NYCB and the other banks, we're going to see credit losses go up. Commercial is going to be first. Then we're going to see consumer come after. And I think this could be very sloppy. You can see the industry in loss for a couple of quarters because they have to divert income to provision. So it'll look like 2008. It'll be much more gradual. It won't be those big numbers, $60, $70 billion a quarter. No, but it'll be very idiosyncratic. You'll have quiet quarters from the bank, and then you'll have a house cleaning one quarter. So I think investors are going to have a tough time managing this as we go forward because they don't know what to do. It's much easier when they have a relatively stable narrative. But if they don't know when a bank is going to clean commercial out or when they're going to sell their Ginnie Mae tubes and just take the hit, that's the problem. It's the unpredictability of it all.
But sorry, David. If to your point earlier, if the biggest concern when it comes to systemic risk is surprise, this isn't to be a surprise, right? So I think
that's why Yellen and Powell are on the wire talking the way they are. I totally agree with them. They're trying to say, pay attention, guys. You need to pay attention to this. And, given who they're talking to, they got to keep it simple, obviously. Because, the equity crowd doesn't want to hear this. The last thing they want to hear is credit problems. But unfortunately, it's been building up for a while. We have 5 years of muted and really deeply depressed credit because of the Fed, because of loan forbearance during COVID. Think about how much everybody's credit score went up because they weren't paying their bills for 2 years. That's scary. So you're going to see above average credit losses on consumer eventually. It could take another year to get up there. And in the meantime, multifamily and urban commercial are going to be great fun. We're just going to have a lot of fun with that.
I'm surprised banks are, you aren't hearing more from banks about the inverted yield curve, right? Like, how long can the banking industry, continue to do business in this environment? It feels like their entire business model was built on borrowing short and lending long, right?
Yeah,
so
that's right.
What happens when you have how long are we in this inverted yield curve? At least 12 months, if not a little longer?
Yeah.
18 months. What is the point where they're just like, whoa, we cannot do this anymore? I mean, any thoughts on that?
Well, what I've been telling my readers is that eventually they will drop short-term rates. That's clear. And the Fed controls short-term rates. But they don't really control the long end. And since the Treasury has to go out and raise $700-800 billion a quarter, I think the long end is actually going to go up. And that's not helpful for mortgages. That's not helpful for a lot of other markets that price off the long end of the curve. But, getting short-term funds down to, 5 or 4.5, I don't think is unreasonable. It would take a lot of pressure off dealers in the street. It would take a lot of pressure off companies that fund their production off of SOFR, mortgage firms, anybody involved in lending. They have short-term loans that they use to finance their production before they sell the loans. So just that change would be helpful. But I think we're going to see a normal curve. Bottom line, I think over time, Dave, it's going to go back to the way it was before 2008. And I'm not sure people are ready for that, but I think you will see relief on the short end. I just think it'll be later in the year. I think they'll stop QT. They'll start reinvesting just in treasuries. I don't think the Fed's going to ever buy mortgage backs again. And then, we'll see what happens to the long end of the curve. I was very happy to see the Treasury and Secretary Yellen sell their full allocation of 10s this time. And I think they got to push the margin on that. They want to raise money at 4%. Because a few years from now, 4% may look pretty good. They should have done that more during COVID. That was a big mistake. They're funding everything off T-bills. And I understand they had to help the Fed rebalance their own balance sheet. But, Bill Nelson at Bank Policy wrote a great note in his missive today saying he just published a paper on why did the Fed get so big. And that decision to go big is going to haunt the Fed for a long time. It was a mistake. And even the Europeans are criticizing them, for Christ's sake. Normally they like going big, but not this time.
Yeah, it's high yield bonds and the United States government kicking the can down the road, watching that.
When the consumer goes sideways, it will be in the chinny bank. Remember that. That's the new subprime, fully guaranteed. But you know what? The loans themselves, they're tough. When delinquency gets up into the double digits, most servicers are going to be losing their shirts.
Which of the biggest banks are you worried about?
Of the top 5, Bank of America. I think they have not managed their duration well. They tend to keep everything. That's always been the historic modus operandi at Bank of America. And during that 2021 period, I think that was a mistake. Should have sold those loans for 104 and bought T-bills and sat there happy. And instead, they retained a lot of securities and a lot of whole loans. And look at their duration. Look at the FDIC data. It'll tell you what the duration is on that side of the balance sheet. So cost of funds is 4 now. Gross yield is 5. So he's working for a point, and then you add 3/4 of a point in there for non-interest contributions to earning assets, and that's it. Running the bank costs 2 points. SG&A costs 2 points. So I worry about that. The rest of them are okay. Citi needs to find a merger partner. I keep thinking about Goldman. Imagine putting Goldman and Citi together. That would be fun. I think it would help them both. We can consolidate a capital markets business. The payments platform is worth more than both of them, right? They just don't have that recognized in the stock price. The consumer book is worth money. Remember Blackstone and Santander thought about trying to buy Citi's consumer book about a decade ago? So I think they ought to break it up and sell it, honestly. I don't think they have a reason to stick around.
Wait, so you're thinking Goldman wants to be a bank even further?
They need to be a bigger bank. They don't have enough funding. They need cheaper deposits. Their cost of funds is right behind Capital One. No, that's bad. And I was so happy to see them shoot Marcus, downsize the credit book, because they weren't doing well on credit. They were losing their shirts on credit compared to the other big banks. Luckily, the book was small, but if you looked at it on a percentage basis, they're not good at it. They should stick with what they know. Do deals, trade the markets. I really, if they could become a broker-dealer again, I would tell them to consider it.
And stay away from Apple. Right?
Well, stay away from, the white label thing? No, you don't do white label credit cards. That sucks. It's an awful business. Anyway, I got to go, guys. I hope this is useful. And
Fantastic. Thank you.
got it packaged up, and we'll do it again sometime.
Thank you.
We
so much.
appreciate the time.
Yeah, we
My
totally
pleasure,
do.
guys. Have a great evening.
You too. Thanks. Bye, everybody.
Bye.